Peter Sorrentino joins us now to talk more about the impact that tariff delay had on the market, the tech sector, and the retail sector today. He is Chief Investment Officer at Comerica Wealth Management. Peter, nice to have you with us. You say basically...
Thank you, Sue. Appreciate the opportunity.
This is a positive, but longer term, things haven't changed all that much.
No, essentially we've got slowing global growth, and so while it is a positive announcement, I think it does sort of separate from the reality that a lot of the ordering and inventory for this holiday season has already shipped. I mean, just look at the time it takes to transship the Pacific Ocean. So a lot of this inventory is already in the warehouses here in the U.S., but it's a welcome development and clearly a shift in sentiment for investors, as you broadly pointed out.
We saw the bounce that these stocks received, but these stocks have all been so volatile recently. I mean, it depends on the next headline of what they're going to do. What does the individual investor do with some of these companies if they don't already own them, if they want to think about them? What do you think?
Well, the fundamentals for this group are still positive. You know, this is really where we're seeing a continued innovation. The Apple ecosystem, as you mentioned earlier, does reach very broadly. And this is a trend that we're going to see going forward, where you've got this interface between the real world and the digital world, and so that continues to expand. We see greater digital content in automobiles. We're moving toward driverless autos. You know, it's an increasing technology push out into, you know, even now the consumer services sector. So the general background for these companies is still very, very positive. This is a short-run positive for them in terms of just investor sentiment, but over the longer term, this is a good group, and anytime, you know, we get an opportunity to buy these stocks cheaper, it's a welcome opportunity.
Speaking of cheaper, how do you feel about valuations? I know it will differ depending on the part of the market that we're talking about, but in general, do you find these companies fairly valued, still overvalued?
One of the problems over the last couple of years is the market leadership has been so narrow, and it's really been confined to a large extent to technology, telecommunication services, and to consumer discretionary stocks. And these valuations have gotten stretched. And to expect additional volatility there, it's not too surprising, you know, given that they were trading on what I would call, you know, a great deal of positive expectation. So, you know, to think that they're going to be volatile going forward and we could see additional downside, that's possible. But again, I think the fundamentals are still very solid for the group, and I would be encouraged by, you know, any adjustment of price to bring them more in line with their future valuation.
Mm-hmm. Before we let you go, I don't want to put words in your mouth, but you don't sound like you're investing in these companies with the trade war in mind. In other words, that doesn't impact your view of these companies long term. Am I reading that correctly?
Yes, because even when you look at Apple, I mean, Apple's sales to China have been declining over the last really 3 years now. So I think you have to take a much broader view of these, and really more of a global view, because in effect, what we're seeing in terms of the automation push out, if you will, into things like consumer services and retail, that's a trend that's going to continue, just as we saw with factory automation. So it's another wave, if you will, of technology, you know, integrating itself into our daily lives, and that's a very positive trend. Mm-hmm. It's a very productive trend for corporate profits. So it's something we're encouraged by.
Peter, thank you. Peter Sorrentino with Comerica Wealth Management.